This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show, episode 1886. Today, our guest is Brandon Hall, CEO and founder of Hall CPA and TaxSmart Investors. Jason and Brandon talk about the benefits of the most tax-favored asset class in America, income property. As Jason always says, taxes are the single largest expense in most people's lives, yet people spend so little time understanding the tax code and learning how they can benefit from it. The tax code is not a secret. It's public information that anyone can access, but our government has made it incredibly complex to understand. But you can beat the IRS at their own game if you know and implement the right tax strategies and loopholes that can save real estate investors thousands of dollars every year. So if you want to learn more, go to jasonhartman.com/TaxSmart to check out Brandon Hall's Tax Strategy Foundation course, where he will guide you through tax strategies available to anyone investing in rental real estate, from the basics of deductions to the complexities of offsetting your W-2 or business income with rental tax losses. So let's get to it. Enjoy this episode with Jason Hartman and our guest, CPA Brandon Hall.
It is my pleasure to welcome Brandon Hall returning to the show. He is the CEO of Hall CPA, and we're here to talk about some tax strategies for real estate investors. As I always say, taxes are the single largest expense in most people's lives, yet people spend so little time understanding the tax code and understanding how they can benefit from it. Numbers are the language of the tax code, and this kind of stuff can save you a lot of money. If you went to his firm directly, you might have to pay, I don't know, $400 an hour for this type of advice. I'm not sure what he charges, but it would be expensive, and it's here for you on the show for free today. And also, we got a couple of different course offerings he'll tell you about that are discounted for our listeners as well. Brandon, welcome back. How are you?
Thank you, Jason. Thanks for having me. I'm good. Thanks.
It's good to have you. So we're going to talk about long-term rentals mostly, but also short-term rentals. And there is a short-term rental loophole. And, some of our clients are doing short-term rentals. I have my concerns about that market, thinking it might be a little oversupplied, but we'll see if I'm right or wrong. I always have to wait to a recession to know.
Yeah.
Yeah. When the travel drops, but that's probably not coming too terribly soon here. Anyway, tell us about the short-term rental loophole. There's a good strategy here, right?
Yeah. Well, and I'll just say too, the first thing that I love about the short-term rental space is that, you could throw your property up on Airbnb and VRBO and you just get instant marketing. And I think a lot of people underappreciate that. Marketing's a hard game in the short-term rental space, but to be able to throw it up on a platform and just automatically get leads is really incredible. So to explain the short-term rental loophole, let me just give you a 30-second of who I am. I'm a CPA. I run a national CPA firm. I've got around 40 employees. We're growing really fast. We only work with real estate investors and operators of syndicates and funds. So we've been in this space since 2015, 2016 when I started the firm. And we've built out this really niche expertise. So we're always kind of thinking about new ideas and new ways to help our clients. Now, one interesting idea or way that you can significantly reduce, potentially even eliminate your tax bill is to invest in short-term rentals. And to explain this loophole, I think I first need to explain how the passive activity loss rules work. Every real estate investor is subject to Section 469 of the Internal Revenue Code. And that section is the passive activity loss rule section. So this is long-term real estate investors, syndicate owners, fund owners, LPs in syndicates and funds, short-term rental owners. Everybody is going to be subject to this section. So it's the most
and LP is limited partnership.
Limited partners, yeah. And it's the most important code section for any real estate investor to understand at a fundamental level. You don't have to understand all the nuances, but you really need to understand how Section 469 works because it's going to significantly alter your tax outcome. So Section 469 was implemented in 1986. Before 1986, you could be a physician earning $1 million a year, go out and buy a rental property.
Or a lot of windmills.
Or anything. Yeah. So you could be earning millions of dollars and buy real estate.
Right.
You could accelerate the depreciation, create these large tax losses from your real estate. And those large tax losses could offset or eliminate your physician income, your any type of income, business owner income, whatever it is. So Congress in 1986 said, hey, it's not fair that high income people are using real estate, rental real estate, as a tax shelter. So we're going to implement a new code section that prevents them from doing this. That is Section 469. Section 469 says that any activity that generates a passive loss, that passive loss can only offset passive income or gain on sale from a passive activity. And if there is no passive income or no gain on sale from a passive activity, then the passive loss is simply suspended and it's carried forward. You cannot use the passive loss.
Okay. So before you move on, Brandon, and please remember kind of where you are in this conversation, but I just want to ask you about that because, a lot of people think I'm a high income earner. I want to invest in real estate. I love real estate. Of course, it's, the best asset class in the world, but I can't take all the tax advantages because it phases out when you earn over $150,000, right? Mm. And that good loss, we'll call it the good loss, the loss you want, it suspends. Mm-hmm. So what happens with that? Just explain that. A lot of our listeners have trouble understanding that because typically when you sell the property, you have a gain, right? You're selling for more than you bought. I mean, pretty much always, right? Nothing's guaranteed except death and taxes. but how do you take advantage of that when it's suspended, when you someday liquidate the property?
Yeah. So suspended passive losses occur when you don't have any other passive income or any gain on sale from a passive activity. So a suspended passive loss carries forward indefinitely until the point that you have passive income or gain on sale from a passive activity. So if I have a rental that produces a $10,000 passive loss and I don't have any other passive income and I haven't sold a passive activity at a gain, then that $10,000 passive loss simply becomes suspended. It's reported on my tax returns and it's going to carry forward until I sell a property at a gain or until one of my properties generates taxable income after depreciation.
So the confusing part there is, though, you have depreciation recapture. So how do you take the loss?
Well, so the loss will first offset depreciation recapture, right? So the loss is going to be ordinary in nature, and that means that it's first going to offset all ordinary gain. So the depreciation recapture is going to be offset. So if you're taking the loss, if the loss is becoming suspended, at some point, you're going to offset this gain that the loss has also created, that depreciation recapture. So you don't have to really worry about that too much. And a lot of people, whenever they have this challenge in their mind of, I'm not getting any tax benefits, what I like to do is press pause, take a step back and look at the bigger picture. The reality is you are getting tax benefits because you're receiving cash flow today that you're not paying tax on, right? So like I could invest in a $100,000 home and I could earn $3,000 of net operating income. We'll just call it cash flow just to keep it simple. I know it's not exactly how it works, but just call it $3,000 of cash flow. But I could tell the IRS at the same time after depreciation that my net operating income was actually a negative $1,000. So that means I've got a $1,000 tax loss that I'm reporting to the IRS. That $1,000 tax loss gets suspended, meaning I don't get a tax benefit from that $1,000 today, but I still earned $3,000 of actual cash flow that I'm not paying tax on today.
Right.
So you're still earning, you're still getting the tax benefits. Right. You got to separate it emotionally, and you got to really look at it objectively.
You know, a lot of times real estate investors, they just don't know how to keep score. They don't know how to do the math. They think they're losing when they're actually winning. And the time they usually realize they're winning is a year later when they go to do their taxes.
Yeah.
You know, they call us up and they say, wow, this is a lot better than I thought. And I'm like, I told you so.
Yeah. Yeah, indeed.
It's the most tax-favored asset class in America.
Oh, it's amazing. It's truly amazing. I started this business because I wanted to see if real estate, like I wanted to see, frankly, rich people's tax returns. I wanted to see if real estate was the way to do it. Because I was young when I was like 25, 26 years old when I started my firm. Yeah. And real estate is for sure the way to go. So that's what I learned through that experiment. But anyway, so let's get back to the passive activity loss rules. Okay. So the passive activity loss rules implemented in 1986. The purpose is when you get that tax loss from your rental real estate, it's passive, it becomes suspended, you can't use it, right? So the government's trying to prevent you from using that $1,000 tax loss that I just talked about. So the passive activity loss rules effectively created two buckets of income. They created the passive bucket of income, and they created the non-passive bucket of income. Yeah. In the passive bucket is any rental property, unless I qualify as a real estate professional. And also in the passive bucket is any trade or business that I do not materially participate in. For example, if I invest in a hair salon and I'm not materially participating, I'm not making management decisions, that's a passive investment that goes into the passive bucket for me. Okay. So in the passive bucket are all rentals and any business that I do not materially participate in. And in the non-passive bucket is any business or job that I do materially participate in. So my CPA firm, for example, I work an incredible amount of hours. So that is in the non-passive bucket for me. If I had a W-2 job, that would be in the non-passive bucket for me. And these rules say that if you have passive activities, losses from things in the passive bucket, you cannot jump those losses out of the passive bucket and put them into the non-passive bucket. That's what these rules say. So these rules basically segregate your activities, and they essentially trap passive activities inside the passive bucket, and you can't jump passive activities out of the passive bucket and into the non-passive bucket. And that's bad because my W-2 income, my CPA firm income, is the income that I want to offset with rental real estate losses, right? That's the high dollar income there. So I want to be able to move my rental real estate out of the passive bucket and put it into the non-passive bucket so that when I do generate that $1,000 tax loss, I can immediately claim it against my CPA firm income. And you can do that jump. So I can jump my activities out of the passive bucket and into the non-passive bucket if I qualify for exceptions under the passive activity loss rules.
So it sounds like most people then want to be able to do that jump, right? They want to move that deduction from passive to active because they're working a day job and they've got active income, right?
Yes. You don't have to, but it's tax optimal. If you want to optimize your financial position, you need to jump your activities out of the passive bucket and into the non-passive bucket. And here's why.
Well, before you go on though,
sure.
Is that true of everybody, or would a wealthy retired person who's got a big real estate portfolio just want to leave it alone and not make that jump? You know, they're not working, right?
Good question. Great question. So if I have a large real estate portfolio and some of the portfolio is generating passive income, some of the portfolio is generating passive losses, and maybe I don't have that much non-passive income, then I don't need to worry about this, right? Because my rental portfolio in and of itself is going to offset each other in most cases. Right. I'll have real estate producing losses, real estate producing income.
But for most people listening,
when we say losses in income, we mean taxable. So this is after depreciation. Very key to understand. Most real estate is going to produce net operating income, positive cash flow, while simultaneously producing a tax loss.
Got it. Okay, so most people want to make the jump. Go ahead now.
Most people want to make the jump, and you want to make the jump because think of it like this, right? Over the past year, year over year, our inflation rate is like 8%. So if I have $10,000 of suspended passive losses that I cannot use, the buying power or the tax benefit there has reduced by 8% every single year. Inflation chips away at my suspended tax losses. That's the key. So I want to be able to use my suspended tax losses, or really my tax losses from rental real estate. I want to use them immediately to protect my tax benefit that's embedded in those tax losses from being eroded from inflation. So it's all an inflation game. It's just like, a dollar today is worth more than a dollar tomorrow. I have a dollar in my pocket, a cold hard dollar in my pocket. I go to the store to buy a half gallon of milk. It's $2, right? Well, I guess I have $2 in my pocket. So it's a $2 half gallon of milk. For whatever reason, I said, I'm not going to buy it today. I go home, I wash my jeans. A year later, I come back. I'm going to the back of the store to buy that $2 gallon of milk. And then I realize, it's $2.06. I reach into my pocket to see how much money I have. I still have the $2. Yeah. But now I need to come up with an extra
Don't
6
worry,
cents.
my audience understands that
right.
one.
Right. So, but what people don't understand. So most people understand that concept. Most people understand, don't leave money in a savings account, right? Because you're earning 0.5% while it's getting eroded by 8% inflation. Most people understand that, but then they always get all confused about cost segregation and bonus depreciation, these tax losses that get suspended. They think it's not a big deal, but the same thing is happening with your rental real estate. You want to move
the deduction forward and take it as soon as you can.
Exactly.
Money today is better than money tomorrow. We get it.
Exactly.
So what's the loophole, though? Tell us about the loophole.
All right. So we just kind of talked about the two buckets of income and how you want to move everything into the non-passive bucket if you can. There's 3 exceptions to the passive activity loss rules that allows long-term real estate investors to jump from the passive bucket to the non-passive bucket. One of those is real estate professional status, which has been talked about a lot, and I'm happy to talk about here.
Sure.
One of them is the $150,000 rule, where if your income exceeds $150K, you can't take your passive losses. And then another one is just simply selling your passive activities at a gain. So if you do any one of those 3, you can move your activity over to the non-passive bucket, which is good. Okay. The 4th rule, or the 4th exception that very few people talk about, is investing in short-term rentals. And the reason that this is incredible is most people have to qualify as a real estate professional in order to move the activity into the non-passive bucket. So most people have to hit the 750-hour test. They have to spend more time in real estate than they do anywhere else. They have to qualify as a real estate professional. Those are the 2 tests.
And they have the 500 material participation hours as well.
That's on top of it. Yeah, exactly. So 750
But that's part of the 750, just so people know.
It's part of the 750. But the key with the real estate professional status is that you have to spend more time in real estate than you do anywhere else. So if I have a full-time W-2 job, I am not going to be able to qualify as a real estate professional. The tax court's not going to buy it.
The way to do this is have a non-working spouse or a part-time spouse that could be the qualifier. But anyway, Let's not go down that rabbit hole. Folks, I've done many other shows on real estate professional. You can go to jasonhartman.com, look them up. And Brandon, I'd love to have you back to discuss that more.
Sure.
But that's one way, real estate professional status, right?
Well, the key that I'm trying to explain with this is the more time in real estate than anywhere else. Yeah. Because a short-term rental is not a rental activity. Right. I just did air quotes for everybody listening. A short-term rental is not a rental activity under Section 469. Right. And Section 469 says all rental activities are passive unless you qualify as a real estate professional.
Yeah.
So what people think is a short-term rental requires real estate professional status as well. But in reality, it does not.
Yeah.
Because only rental activities are passive unless you qualify as a real estate professional. Short-term rentals are not rental activities. So if I invest in short-term rentals, I don't have to worry about real estate professional status.
Right.
All I have to worry about are those material participation tests that you just brought up. And there's 7 of them. And I'll run through the top 3 real quick because it's really important to understand.
Because I'm about to ask you, if you have a manager for your short-term rental, is that going to disqualify you? Go ahead.
If you have and we can talk about that. Yeah. But the key is the key to understand is that I could have a W-2 job. I could have a full-time job and no spouse.
Yep.
Real estate professional status is off the table for me because I can't spend more time in real estate than my W-2 job.
Yep.
But I can invest in short-term rentals, and I don't have to worry about spending more time in real estate than I do anywhere else. I can have a W-2 job. I can invest in short-term rentals. I can cost seg, bonus depreciate it, and I can take my tax loss from my short-term rentals against my W-2 income. I don't have to jump through any other hoops. I do have to materially participate. That's the loophole. The loophole is that I don't have to worry about the higher standards of real estate professional status.
Yeah, that's great. But what are those top 3 material participation tests of the 7?
So to materially participate, from easiest to hardest, the top 3 tests, there's 7. You only have to meet 1, but the top 3, your participation is substantially all of the participation. That means that I self-manage, I turn the unit myself, I pretty much do everything myself, right? Yeah. But the cool thing here is that in theory, and I'll say in theory, don't take this for, my word for it, but in theory, I could spend 40 hours a year managing my short-term rental, and I can materially participate as long as nobody else touches it. The bar is really low. That's the point. So the first test is my participation is substantially all the participation. The second test is I spend 100 hours and more than anyone else. So if my cleaning crew spends 102 hours, then I need to spend 100 hours and more than them, so 103 hours, right? So that's the second test. The third test is that 500-hour test that you mentioned.
Yeah. That's tough. That's going to be hard for most people listening.
It's a lot easier than you think, because what we've seen a lot of our clients do is actually start self-managing their rentals with the software that's out there today. You can do it.
Right.
You can't always do it, but you can do it, and you can do it relatively easily. All you have to do is coordinate your cleaning crew and your linens. And then you put up a couple Ring cameras to make sure that everything's going okay.
Yeah. Right. I'm proud to say that I am self-managing all of my long-term rental portfolio. I do have one short-term rental. I'm kind of more of an experiment, maybe, more than less. And I do have a manager for that one. So interesting. But I highly recommend self-management because, you might not believe this, Brandon. What was it, like 10, 12 years ago or something? I actually got audited. I've only been audited twice in my whole life. And both times the IRS really got a bad deal, so they don't come back to bother me too much, thankfully. And I've like complex tax returns, multiple entities, many businesses, etc. So that's like an audit target. But I got audited for real estate professional. Me, of all people, right? And one of the things, and I did win. I won the audit, thankfully. It was a huge win. I mean, I got like over $400,000 back from the IRS. It was beautiful. Wow. I loved it. It was a great deal. But anyway, one of the things they tried to say is, you don't self-manage all of your properties. You have some managers. Yeah. And so you don't have enough material participation. It all hinged on that 500 hours of material participation. Thankfully, I won, but, I might have lost, right?
Yeah.
And I just love self-management. It's just so much easier. It actually takes less time counterintuitively than having a manager because you don't have someone with a conflicting agenda. So, yeah. But on the short-term rental, I don't know. It's
I bought a beach home in September of last year, and I've been self-managing since. And it's just all about systems. It's just like any other business, right? Sure. And if you set the systems up, you use the software in the right way, you can automate a lot. Of course, the more that you automate, the more your material participation hours go down. So you have to be careful. Yeah. But you can totally self-manage. And at the beach, these management companies take 15, 20%. Yeah. And I was just like, okay, well, I can at least take it on the chin and try to self-manage for a year and get paid that 15 to 20% as a result of my efforts. Yeah. And it's been going pretty well. It's pretty smooth. You gotta deal with the random questions that get asked every once in a while. But it's okay.
One of the big keys to that is just having a good house cleaner that really becomes a sort of extension manager, right? Where they kind of keep an eye on everything for you. But anyway, okay, good. So one of the things that I think is highly overlooked, and you've got some slides to share with us, I want to see those. But one thing that I think is highly overlooked, and it's very hard to calculate the ROI on this, but that is over the course of years, the huge benefit of 1031 exchange. I've just done a whole bunch of those on my own portfolio. I'm in one right now, and It's just incredible to be able to reinvest pre-tax dollars. With other investments, you might think in the stock market or cryptocurrencies or whatever, you're doing better. Of course, you're not lately, you're not thinking that, but in general. But the 1031 exchange is just huge. The way that compounds that benefit, it's incredible. Yeah.
Oh yeah, exactly. In all, what we're talking about is not only compounding the dollars that we've invested, but we're also talking about compounding tax savings. We're talking about just compounding all the equity that we've earned as well. You're just trading up, right? You just keep buying bigger, larger assets. But the nice thing about the 1031 exchange too is you could always do that cost seg bonus depreciation on that first rental you buy, and all that depreciation recapture can get rolled into the next property as well. With the 1031, and then you can do a cost seg again on the new property. It starts to lose its value. The cost seg starts to lose its value as you move up in value with a 1031 because you have less cost basis as you move up. But still, you can keep doing it, producing a lot of tax losses for you on a consistent basis. Yeah, good. But show us your visuals and talk to us about those. So real estate professional status, again, we have two buckets of income, passive income bucket, non-passive income bucket. The goal is to move my rentals out of the passive bucket and into the non-passive bucket. Qualifying as a real estate professional is one way to do that. But it's also important to understand that qualifying as a real estate professional only allows you to overcome the presumption that your rentals are passive. Basically, it means absolutely nothing unless you also materially participate. So kind of like what you said earlier, Jason, you have to qualify as a real estate professional and you must also materially participate in your rentals. You can do them both at the same time. That's fine. But where we typically run into issues is where we have like a real estate broker who does brokerage full time. They're a real estate professional because they meet these two tests: 750 hours in a real property trader business and more time in a real property trader business than anywhere else. But real estate brokers, builders, contractors typically forget that they must also materially participate in their rentals. So even though they can be a real estate professional, they don't have the material participation in their rentals. And so their rentals are still passive. So that's the thing that I wanted to show you on the real estate professional status. And then I do want to talk real quick about the hours that count and don't count. Investor level hours, like time spent reviewing like financials, filing taxes, paying bills, doing bookkeeping, that time's not going to count for material participation or for real estate professional status hours unless you're involved in the day-to-day management. So here's another positive point for self-managing, because a lot of people, especially at a distance, especially in the short-term rental space, that this is the stuff that they're doing. They're paying bills, they're managing those financial statements, doing the bookkeeping. None of that time is going to count as material participation hours unless you're involved in the day-to-day management, which effectively means you can't have a property manager. Education and research does not count. And I put tax court cases here. We got half a pour versus commissioner for those that are listening. And then also Padilla versus commissioner, because I typically get pushback when people are learning about this stuff. They go, why wouldn't my education and my research count? Why doesn't my time spent, sourcing all these deals count? And it's just because that time's not actually spent operating your landlording business, right? It's important. It helps expand, but the tax court is going to consistently say that education and research time does not count. They're too easy to log, basically. And then your travel time could potentially count, could potentially not count, depending on the facts and circumstances. If the travel is all local, like it was in Lay versus Commissioner, then you have a good chance of your travel time, local transportation time counting. If you have to travel an hour and a half to your short-term rental or to your property, and you're doing that a handful of times a year, then that travel time is not going to count as real estate professional status hours or material participation hours, as we found out in Lucero versus Commissioner, which was a tax court case in 2021. I want to hit the excess business loss rules. So I feel like a lot of people are unaware of the excess business loss rules, but it's really important to understand these rules because everything we're talking about is trying to accelerate the losses from my rental real estate activities. But the reality is that if my only business is being a landlord, then my losses are going to be capped going forward. So starting in 2021 on your 2021 tax return, these rules came into place. Basically what they say is any loss in excess of business income is called an excess business loss. And you can claim up to $250K of that if you're single, $500K of that if you're married filing joint, but anything in excess of that is suspended. And you can take it next year. right, as a net operating loss, or any future year as a net operating loss. So let me break that down. So if I have $0 of business income, so let's say I don't run a CPA firm and I'm just a W-2 employee, I have $0 of business income. I am married, so I can claim a $500,000 tax loss from my rental real estate activities. So if I go and buy a couple short-term rentals and I cost segregate them and they produce a $700,000 tax loss, and I'm non-passive. If you're passive, this doesn't matter. This is only for the non-passive. So $700,000 tax loss. I'm non-passive in those short-term rentals. I can only claim $500,000 of it today because I'm capped due to these new rules. So these rules came into effect in 2021. The remaining $200,000 in this scenario is carried forward to next year, where I can claim it next year potentially as a net operating loss. Really critical to understand, because I see a lot of our clients continuing to buy these multi-million-dollar buildings, continuing to go through these cost seg studies, continuing to generate large losses from their rental real estate activities. But the reality is that if you are successful in qualifying as a real estate professional and materially participating, if you are successful on the short-term rental side, materially participating, then the non-passive losses that these rentals are creating are subject to these new rules. You can only claim $250K of that loss if you are single, $500K if you're married, filing joint. The exception here, or the way around it, is if I'm running my CPA firm and I generate, let's say, $500,000 of net income, if I can take a dollar for dollar loss deduction for that, so I can take the full $500K, and then I can take an additional $500K. So this loss cap is only on the losses in excess of my total business income. So if you're running a business and you're generating business income, you're probably okay. If you're working a W-2 job and you don't have any business income, then your losses from your rental real estate are going to be capped at $250K if you're single, $500K if you're married, filing joint.
So if you've got a big portfolio, you do cost segregation to bring forward the depreciation deductions. Rather than waiting 27.5 years, for example, you can bring them forward to 5 or 7 years, right? Mm-hmm. And these benefits add up to more than $250,000 in tax deduction if you're single, or $500,000 if you're married. Then you can take that each year, though. Say you've got $1 million in accelerated, if you will, I know it's not the exact right term, but depreciation, right? Because that's the old system. But you can take them over the next 4 years, right? Like a single person with $1 million, $250,000 a year, right?
Yes. So the key here is,
it's not that bad. You just can't do it all in 1 year.
Right. Well, and the key here to understand too is that my losses can always offset business income or rental income. So if I have rentals generating positive income after depreciation, and then I have rentals generating taxable losses after depreciation, they can always net out. The key is that when I look across all of my businesses and all of my rentals, if I have more losses than I do income, then I'm subject to these rules. And so who this really hurts is people who are retired and earning Social Security. This hurts people that have large capital gains in the stock market, for example, and they're trying to liquidate their positions. This hurts people with high W-2 incomes. It's not going to hurt people that are running businesses, because I can always offset my business income, and then these rules start kicking in. It's for people that don't have business income that are going to get hosed by these rules.
Yeah. Okay. All right, good. Okay. What else do you want to touch on before you wrap it up? Just sum this up for us. We could talk forever about tax. You got over 70,000 pages of tax code. I'm sure it's increased by now. That's an old number. But.
Yeah. I mean, I think a lot of people were very scared about the Biden tax plan, and it's starting to get kicked around again in Congress, but the general consensus is that it's not going anywhere. So you can kind of just take a big sigh of relief. Although the final plan that eventually got voted down didn't really have a whole lot in there to concern real estate investors as it was. So a lot of talk, not a lot of action. I mean, that's pretty much it. I mean, look, if you're a real estate investor, you really have to know the passive loss rules. You really do. Everything that I just described, we have a lot of content on it. We have a Facebook group. We have courses that can educate you on it top to bottom. And if you understand these rules, you will truly be executing that that rich dad, poor dad, my cash flow streams offset each other and I never pay taxes in my life. That is the passive activity. Those are the passive activity loss rules. So you have to learn those rules. And once you do, it's just, you start to see things a lot clearer as you build your portfolio.
Yeah, that's great. And by the way, you can get Brandon's courses with a nice special offer for our audience at jasonhartman.com/TaxSmart. That's jasonhartman.com/TaxSmart. So check out that URL. It's going to be special offers on 2 products. One is a overall tax boot camp, and then the other is a short-term rental course that's shorter. So some good stuff there. Check that out. Remember, income property is the most tax favored asset class in America. And kind of what you alluded to about the Biden plan, it's always been this sacred cow, right? They just don't mess with it too much. I mean, I guess probably the biggest change was the Reagan reforms of 1986 that you mentioned at the beginning. But overall, there's just so much power and so many lobbyists and so many politicians that benefit from these tax benefits that they're not going to take them away too easily, folks. So it's a great asset class. Brandon, thank you so much for joining us. We really appreciate it. Appreciate your insights. Thank you.
Thanks, Jason, for having me on.
Hey, buddy, just wanted to say thanks again for the awesome job you did Friday morning. That was great. Just started out our day perfectly and put a cap on our event. I just thought it was awesome, man. You did a great job. But even more than that, just appreciate your spirit in the room, man. Seemed like you're just more alive and just more enthusiastic than ever about things you're working on and things the family's doing. So I just want you to know I appreciate you, man. Travel safe.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.